Hello, this is Simon Thompson, Vice President and Wealth Advisor at Texas Legacy Wealth Management. Welcome to our monthly market update for July 2016. We're going to walk through the major market events of the month. July was a very strong month for the S&P 500 as stocks soared to new all-time highs, ending the month up 3.4%. We had not seen a new high in roughly 14 months. So seeing the S&P close and remain above the 2130 level could be seen as a sign of longer-term stability in the market. We started the month with solid and better than expected economic data, which helped boost stocks into Q2 earnings season, which has surprised to the upside so far. As we move further into the third quarter and closer to the U.S. presidential elections, heightened focus will be placed there. At the beginning of July, investors were focused on how the Brexit vote would impact economic data in the U.S. and overseas. The overwhelming result was that the post-Brexit economic data was not impacted much at all, which helped calm jitters and push stocks higher. Here in the U.S., July readings for manufacturing and employment came in strong and better than expected. The PMI reading of 53.2 beat the consensus estimate of 51.5 and continues to show renewed strength in the health of the U.S. manufacturing economy as readings above 50 signal expansion. We also had a surprisingly positive jobs number with 287,000 jobs added compared to the 180,000 that was expected. This was a big turnaround from the prior jobs report, which had a surprisingly weak reading of only 38,000 jobs added. The better than expected optimistic data, as seen in the Citigroup Economic Surprise Index, helped boost confidence in the economy. During the second half of the month, earnings season took center stage. Thus far, this earnings season has been better than expected, with the biggest surprise being the results for the technology sector, with positive revisions in earnings estimates for the third and fourth quarter, which weren't widely expected. With the U.S. election around the corner, investors will be paying closer attention to the rhetoric of the presidential candidates and how the election's outcome may affect their investments. However, maybe it should be the candidates paying attention to the market. Historically, 82% of the time, when we see positive stock returns leading up to the election, the incumbent party wins, while negative stock returns tend to signal a challenger party win. We will see if this holds true during this election cycle. As we look toward the latter half of 2016 and the beginning of 2017, there's still uncertainty hanging over markets as all eyes are on the U.S. election, the Fed, and moves from central banks around the globe. While we continue to feel that positive returns for stocks by the end of the year are certainly possible, especially given the continued solid economic data, we would not be surprised to see further volatility. We believe now is a great time to review overall asset allocation, particularly if the volatility we've experienced throughout this year has been uncomfortable. The recent rally has presented a good opportunity to address asset allocation and ensure it's in line with long-term goals and objectives. For more information about Texas Legacy Wealth Management, you can contact us via phone, email, or feel free to visit our website. We'd also like to remind you to follow us on Twitter and like us on Facebook. Thank you.